Follow the money. It always leads somewhere they didn't want you to look.
In 2000, Netflix proposed a partnership with Blockbuster, which was declined. By 2010, Blockbuster filed for Chapter 11 bankruptcy protection. This decisive moment in business history has since become a case study in missed opportunity and the pitfalls of underestimating technological innovation. But what led to this drastic downturn? The answer lies in a series of business decisions that failed to anticipate the rapid evolution of consumer behavior and technology. At the turn of the millennium, Blockbuster was a dominant force in the home entertainment industry, operating over 9,000 stores worldwide. The company's revenue in 2004 reached approximately $6 billion, a testament to its influence and reach. Yet, less than a decade later, its stores were closing rapidly, unable to compete with the growing trend of digital streaming and on-demand video services. By 2011, Blockbuster's assets were sold to Dish Network for approximately $320 million. What happened in between? In 2000, Netflix was a fledgling enterprise, primarily offering DVD rentals by mail. Blockbuster dismissed the company as a minor competitor, focusing instead on its extensive network of physical stores. However, Netflix was on the cusp of a major transformation. By 2007, it introduced a streaming service, redefining how audiences accessed media content. A seemingly innocuous detail at the time, a shift from DVDs to digital streaming, would later prove to be a game-changing innovation. How did Blockbuster respond? Blockbuster attempted to adapt by launching its own online service in 2004, but by then, Netflix had already captured a significant portion of the digital market. Blockbuster's response was further hampered by its late commitment to the online model and the burden of maintaining a costly network of physical stores. In contrast, Netflix had no such overheads, allowing it to invest heavily in technology and content licensing. A critical moment came in 2007 when Blockbuster's then parent company Viacom decided to spin off the business. This decision stripped Blockbuster of much-needed capital and strategic support, leaving it vulnerable in a market that was swiftly moving towards digital solutions. The inability to pivot effectively and the lack of foresight into the digital future were becoming evident. How did this miscalculation affect their bottom line? By 2010, Blockbuster's revenues had plummeted to $3.24 billion, just over half of what it had earned 6 years earlier. The rapid decline was stark. While Blockbuster struggles with financial losses, Netflix was thriving, boasting over 20 million subscribers by 2010, which would later expose all of Blockbuster's financial woes, highlighted the discrepancy between the two companies' fortunes. As Blockbuster faded into history, questions linger about the nature of innovation and the importance of recognizing technological shifts. What other industries might face similar fates if they ignore the signs of change? The Blockbuster blunder offers a cautionary tale about the costs of complacency and the ignorance of innovation. The spreadsheet that exposed Blockbuster's financial vulnerability revealed a staggering $1 billion in debt by 2010, a burden exacerbated by its inability to generate sufficient revenue from its dwindling physical store operations. This debt was compounded by late fees, which once constituted a significant portion of Blockbuster's income. In its heyday, late fees accounted for approximately $800 million annually. However, as consumer preferences shifted, this revenue stream dried up, further constraining the company's finances. Meanwhile, Netflix was capitalizing on its subscriber growth and technological advancements. By 2011, Netflix had not only surpassed 25 million subscribers, but also begun international expansion, starting with Canada. This move signaled Netflix's ambition to capture a global market, a foresight that Blockbuster lacked. Blockbuster's international presence, once a strength, became a liability as the costs of maintaining overseas stores outpaced their revenue. The contrast between the two companies extended beyond financials. Blockbuster's strategic missteps were mirrored in its leadership decisions. In 2007, As Netflix was launching its streaming service, Blockbuster's leadership changed hands once, creating instability. Jim Keyes, appointed CEO in 2007, focused on revitalizing the physical stores, believing they were Blockbuster's core asset. This decision clashed with the emerging digital landscape that demanded a shift in focus and resources. By 2009, Netflix's stock price had climbed to over $50 per share, reflecting investor confidence in its digital strategy and growth potential. In contrast, Blockbuster's stock was trading below $1, a stark indicator of the market's perception of its future viability. The disparity in stock performance underscored the growing gap between the company's strategic directions and market positions. Blockbuster attempted a last-ditch effort to modernize by introducing a kiosk rental service, mimicking Redbox's successful model. However, the initiative was too little, too late. Consumer behavior had already shifted towards streaming, and kiosks, while convenient, did not address the underlying technological shift that Netflix had embraced. As Blockbuster's decline accelerated, Netflix continued to innovate, investing in original content production. This move not only diversified its offerings, but also reduced reliance on third-party licenses, securing a competitive edge in the entertainment industry. By 2013, Netflix's original series House of Cards premiered, marking a pivotal moment in content strategy that further entrenched its market leadership. Blockbuster's collapse raises questions about the role of leadership in navigating technological disruptions. Could more decisive action have altered its trajectory? The narrative of Blockbuster's decline serves as a reminder of the critical importance of adaptability and foresight in an ever-evolving market landscape. What lessons will future companies draw from this cautionary tale? The downfall of Blockbuster serves as an emblematic case of a major company failing to adapt to technological change. As Netflix embraced digital streaming and content innovation, Blockbuster clung to its physical stores, unable to pivot as swiftly. This strategic inertia is reflected in their financial trajectory. Blockbuster's total assets had dwindled to under $1 billion, a drastic reduction from its peak. Meanwhile, Netflix's market capitalization soared to approximately $13 billion by 2013, driven by its growing subscriber base and original content offerings. The contrast in trajectories highlights the importance of recognizing and responding to market shifts. Blockbuster's leadership, focused on short-term stability, missed the long-term implications of digital disruption. The decision to prioritize physical stores over digital innovation proved costly. Emerging financial data from 2010 showed Blockbuster's operating income sinking into the red, further exacerbated by its sizable debt obligations. As the company's financial health deteriorated, its ability to invest in new technologies or strategic pivots was severely curtailed. In parallel, Netflix's strategic choices underscored the power of foresight. By investing in streaming technology early on, it positioned itself at the forefront of the digital revolution. Netflix's decision to develop original content further insulated the company from the volatility of content licensing agreements. This approach not only strengthened its brand, but also allowed Netflix to control its distribution channels more effectively. Blockbuster's attempts to compete in the digital space, such as its late entry into online rentals and kiosk services, were reactive rather than proactive. These efforts failed to capture consumer interest, largely because they did not address the fundamental changes in how people consumed media. The convenience and instant accessibility of streaming services had already redefined consumer expectations. As Blockbuster filed for bankruptcy in 2010, it became evident that its once formidable global presence had transformed into a cumbersome liability. The cost of maintaining physical stores worldwide was unsustainable without a corresponding digital strategy. In contrast, Netflix's leaner, technology-driven model allowed it to expand internationally with minimal overhead. The story of Blockbuster's decline prompts reflection on the broader implications of technological change in business. As industries continue to evolve, the ability to anticipate and adapt to new trends becomes paramount. Blockbuster's experience raises a critical question. In a rapidly changing technological landscape, how can companies ensure they are not left behind? The lesson is clear. Innovation is not merely an option, but a necessity in sustaining relevance and competitiveness. The narrative of Blockbuster's rise and fall remains a potent reminder of the risks inherent in complacency. As companies navigate the complexities of the digital age, the Blockbuster blunder serves as a cautionary tale about the imperative of embracing change. What future industries might face similar challenges, and how will they respond to the lessons of the past?